Is it surprising to you, though, Rob, that in the face of now a new war, notwithstanding the Fed comments, even that the market, that's equities that is, have been so resilient today?
Yeah, equity resilience has surprised me in a lot of ways over the last year or so. It shows you how keyed in they are on the Fed because futures and early market action, I mean, you guys would know better, but the equity markets were looking a little wobbly, and then they caught a little bit on Fed comments. But to me, the Fed's just delivering their same message. They're data dependent. The data's been okay, so that's kept this idea of a hike on the table, which has kind of rattled the equity market. But now they're starting to ask a question. The Fed and investors should ask this question: is are rates higher? Especially this latest move, it's really been the long end of the curve. Are rates higher due to economic strength that's going to continue to go and require more hikes? Or is the curve getting steeper because investors are starting to demand term premium? I'm starting to demand some extra compensation to go out on the curve because risks are rising overall. And if that's the case, then no hikes are necessary. They can be patient. And I think financial conditioning, they're acknowledging they are tighter, and that lag effect's going to hit the real economy. And so that's fine. The Fed can use their forward guidance. They can use QT. They don't need to hike rates. But I think things are getting riskier, and the defensive posture is better, regardless of how they're handling it today.
Well, they do seem to be acknowledging what you're talking about. At least the speeches that we heard today seem to gesture more at that term premium impetus rather than sort of the fundamentals of the economy changing. So what does that mean for an investment perspective then in terms of what one should do with bonds right now, for example?
Yeah, I mean, thinking about an asset allocation, I would start to think you were just given higher rates and a steeper curve. So if you were thinking about extending duration or adding to your bond portfolio, it just got even more attractive. So for one thing, the macro geopolitical environment over the medium term suggests actually having bonds over stocks. This is not 2022. We're getting significant carry in fixed income, right? You're getting almost 0.5% in core fixed income a month. You weren't getting that in a year. About a year and a half ago, it took a whole year to get that. So one thing you can do is start thinking about that. And that's why we're talking about the term premium more, because to get people out of cash into duration, you need some compensation. And that's why the curve's steepening. They're kind of giving you that signal. So I think extending duration, overweighting bonds, but being careful on the credit side, because all the same things that I've been talking about that may plague the equity market are going to could plague credit down the road.